Deepak Shenoy as well joins in on the show right now. Deepak, hi, afternoon. Autos, Deepak, that clearly seems to be one space which is flaring up. Mahindra and Mahindra already at 1,400 bucks on the futures. Tata Motors at a 52-week high. Time to profit take, or do you think there's still further legs to go in this entire sector's rally?
Afternoon, Aisha, and I think we own M&M, so quite biased in that perspective. But yeah, I think they haven't. M&M's done very well, but a lot of the other auto companies are still lagging behind in terms of actual sales. Stock prices seem to have gone up quite a bit. So I think the expectation is that at this point. Maybe, I mean, one day moves don't make a market, of course, but maybe the expectation is that the numbers will come in well. We haven't seen the monthly figures as yet. I don't think there's anything significant that's changed in May. But we'll wait for all the numbers to come in. Usually, take a look in the after the first week has come in. But very positive longer term, at least on the personal vehicle story and also on commercial. M&M and Tata Motors are more into the commercial vehicles play, though Tata Motors is more a conglomerate now. So M&M is a better play in that respect. We like all these companies in general. Two-wheelers are still lagging, if you ask me.
However, the numbers this time from two-wheelers was better than expected just because the expectations were very muted when it comes to the two-wheeler space. But Deepak, what's the take as far as the defense pack goes? Do you have any investment there? Is there any name that that is on your radar?
So we do have investments. To be honest, we're a little surprised by the moves in some of these stocks today. I mean, you can't explain a 17% move in a Mazgao dock just like that. But I think, see, in the longer term, the story here is simply import substitution. A large part of defense capex used to be funded from our imports. So we used to import technology, we used to import even end products from abroad. Now there's a large amount of manufacturing that's happening locally, both fresh and even from the stuff that we used to import earlier. Some parts of the of the items that we used to import are now being manufactured locally. The import substitution itself is a large play. There's a 50 to 60,000 crore capex bill that I think will move over time substantially to Indian companies and perhaps more capex as well. Very interested in this space because it's one of the areas where there's a substantially higher impact. Other than BL, a lot of these companies are sub 25-30,000 crores in market cap, and an increase in import substitution can actually change their fortunes, to the order of 50, 100, 200%. We've seen that in Mazgao in their results, but a bunch of others also, I think there will be, a substantial improvement. We do have investments, so quite biased, but I think the next 1 or 2 years, we should see continued improvement in the financials here.
Those 2 or 3 names that you invested in, or the top 2 or 3 picks from the space?
So I think, honestly, we've, sorry, is that for me? Yeah. So we're still invested in Mazgao. We have an investment there. We have investment in a smaller company called Data Patterns. We've been invested in a few other names in the space. This is, a initial set. Of course, the numbers have started to roll in. We're hoping that over a 5-year term, their returns will be quite good. The stocks have run up a lot. So just as a warning, we are okay investing over a long period of time. So I don't have to jump in all at once. But to anybody jumping in, you have to make sense of the price for yourself before you make a call. This is a long-term investment, so it may not necessarily pay fruit in the really short term.
Right. Okay. I must say, Deepak, there was quite a list of caveats there on whether and if to, invest into the defense stocks, but get that point.
But Deepak, you're quite positive about the defense pack, but could the same be said for railway as well? Because in the year so far, we have seen a massive rally in a lot of these railway counters.
Again, yeah, I think the same story here plays. I believe here import substitution is a thing. We used to get a lot more done from companies abroad. Sometimes they would fund railway capex and therefore require that, for instance, if you get funding from a Japanese from Japan, then Japanese companies would kind of do that. Now it's not so much that it's the railways placing their own orders, their own technology. A lot of the train sets and the technology has actually come from the railways themselves or in collaboration. I think this is a solid play. Again, we've invested here, but one of the things to be careful here is only that a large amount of orders here are still PSU government based. So they could be potential derailment in case, for instance, political changes happen in elections and so on. We've seen this in certain states where when the political power has changed, there have been slowdown in payment for certain contracts and so on. Those are risks that are in such PSUs or in such areas over a longer term. But I think we will continue railway modernization for a substantial amount of time. The budget was, I think, originally 400,000 crores for 4 years. We're down 2 years. We're in the third, so we should see more investments come in on the back of even the freight changes that is happening with the dedicated freight corridors in the north and the northwest and the northeast, and upgradation of the southern freight network as well. I think we're going to see a substantial amount of activity. So there's going to be money made in almost everything from signaling to the coverage systems to electrification to new train sets to Vande Bharat. I think there will be a lot of activity in the next 5 or 10 years. Very positive on the sector.
But aside of defense and railways, Deepak, what is the best way to play the entire manufacturing theme?
I think the idea here is there's other parts of things also. For instance, you have engineering, precision engineering is another play. We've got some players there, and some of the stocks have also run up recently. The precision engineering it's a B2B space, so it typically caters to other industries. But again, India's market has been relatively small, so as manufacturing increases, these B2B players will increase. A large amount of earlier capacity additions were all in the commodity space, whether it was steel or aluminum or things like that. But now they're getting into more advanced players, whether it is semiconductors or defense or railways. You're going to need a lot more manufacturing from cams to turbines to even pump sets also, for instance. That's another place where you're going to see a lot more demand, not just from agriculture but also from industry. So I think over here it will be, while I call manufacturing a very large sector, one area has been auto, where autos and auto ancillaries have done well. A lot of things have been developed in India, but a lot of the remaining part, whether it's the railways, heavy engineering, or precision engineering, you've not had much of a focus on domestic consumption. Some of it is export led. I think that is where we're going to see a lot more interest. Not very useful to talk about. So in the sense, it doesn't come out with those things that says buy this because it looks shiny. But I think a B2B play here, silently working under the radar, high ROCs, will emerge in the next 5 or 10 years.
Okay, the slow and steady movers there, but
How critical would the policy this week be, or do you think a status quo is well in the price?
Well, I think I'd be very surprised if they dropped interest rates. I'm definitely not going to raise them. Inflation is now in the corridor, so I don't think they should raise or drop interest rates yet. Even the GDP growth number that has come in above RBI's expectations. So there is no reason for them to change or tinker with rates if inflation is within expectations and GDP growth is kind of better than expectations. But we might see something more in terms of banking regulation and regulatory changes. I don't know. I mean, we can't predict right now about what it is, but I think that may be the bigger driver of change here than interest rates. I think they will, for instance, introduce more regulation on the NBFC sector that has been coming or forthcoming for a while now. They will also, so that might, change some sort of sentiment. And also, we've seen personal loan growth at very heady levels. Now we have 11 lakh crores in personal loans. compared to, I mean, it's now 1/4 of what we've lent to the industry, and it used to be 1/10. So personal loan, unsecured personal loan growth has been quite high. So there may be some comments about that. But otherwise, I don't see a major impact. Rates have already fallen in the market to less than 7% now on the 10-year. So I don't expect a major change this time.
Question actually to you, Deepak, as well. If you had to pick one top name, let's say one name from NBFCs, one name from private banks, and one from PSU banks, which would those three names be?
That's a good question. Actually, I probably wouldn't even take the trade if I had to pick only one, because you generally, shouldn't. Because I think some of these things are. Specifically in private banks, we have an investment in ICICI and Kotak. I don't think this is necessarily reflective of the entire industry. I think there will be some banks that might grow more, but I'm more comfortable with larger, more diversified banks. And which have diversified holdings. HDFC is currently going through that merger process, and we're not very enthused about IndusInd at the moment. So that's there. In a private bank, in public sector banks, I don't think it's a great time to hold them. I think they are priced a little bit higher than where they are likely to be going forward. SBI is a good bank. It's a phenomenal entity. It's really aggressive also. If I were to pick a PSU bank, it would be SBI, honestly. I just think the price is not right. I probably won't pick up an NBFC now. I'll wait for RBI policy. We're expecting a lot more regulatory focus to come, at least on the top NBFCs. And some of them are priced to perfection. So, you don't get a great opportunity right now. So not entering, but, we might choose to buy after the RBI policy. Just sticking with the larger cap banks right now.
Not HDFC Bank though, Deepak, because much of the concerns seem to be well behind us. The stock is already at a 52-week high. What concerns do you still have on how the merger is going to play out?
So there's stuff around the merger which we don't know specifically. For instance, they have a large amount of land exposure through HDFC, which they will not be able to have going forward. Of course, they'll grandfather the earlier situations, but a large amount of the housing space, for instance, when you fund developers, you have to fund them both for current projects and for land acquisitions going forward, because they need both. And for some strange reason, they keep needing money all the time. But that part of the activity will not be able to be continued by HDFC Bank, at least the land part of it. The most of the other concerns are kind of done with. But I think from a growth perspective, it's better to stick with a more with someone who has more corporate focus as well, like ICICI does. And HDFC has demerged a large amount of its other entities, insurance, the AMC. They're all independently listed so far. So ICICI and still continues to have the AMC that's unlisted. Kotak has the AMC and the insurance arms that continue to be part of it. So they will be, I think, there's a more, a better corporate structure in terms of ownership as well. Nothing against HDFC Bank. I just find these two more attractive at this point.
And I stand corrected there. We're still 8% away from the 52-week high on HDFC Bank. But Deepak, what about FMCG? That seems to be clocking new highs for sure. Still continue to hold if you are already riding the wave on FMCG stocks, or do you think it's time to profit take a little bit?
So, good question. Shorter term players will probably want to prune positions, because you would have seen this reach a much higher percentage of your portfolio simply because of the run up, especially in stock names, certain stock names. We own some, we own a VBL and so on. So they're quasi FMCG, if you may, but there is. There are a lot of names over there that have run up quite recently, quite reasonably well. I would say here that some of the results are actually quite good. So Nestle has been very good on the result front as well. But a lot of them are still growing at the 8 to 10% range. I won't take names, but I would say if you're paying 80 times earnings for something that's growing at 10 to 12%, there will be a correction sometime that brings your price down without the company having to make a loss, simply because the expectations were too high. I think those are the kind of names, I mean, I wouldn't get into at this point, and I will probably prune positions if I held them. But that's one part of the process. But I think a large amount of the gain that's been happening recently is just because of the recovery. I don't think they'll be able to sustain a lot of earnings growth going forward. Uh, I think better bets are there in the manufacturing sector. More growth is there.
Just coming back to the point that we were discussing on financials, Deepak, have you looked at the entire microfinance space? It's seen stellar result in the earnings season that just went by. Credit Access, Fusion, Five Star, you name any of these names, even Ugro, etc. Is there any name which you think is part of the investable universe?
So I think a lot of them have come out with good numbers. We haven't taken a call on any of them yet. They've done better than expected in what has been a relatively trying time. The microfinance sector isn't actually interest rate sensitive. They literally pay any interest rate that they can get, and they're paying relatively high, so 29-30% kind of rates anyways. What will happen, of course, is because of relatively recent high growth. Uh, the Microfinance industry, goes through phases of high growth, and then it goes through phases when growth is low and their NPAs shoot up substantially. This might be one of those high growth phases, and the stock prices have also gone up to reflect that. But we fear that the slower growth phase and high NPA phase is probably a year away from where we are right now. So we're not keen to make too many bets here. Of course, it will depend on an individual basis. Some MFIs have done really well and controlled NPAs so far, even through bad times. So I shouldn't generalize, but in general, my fear about the MFI industry is just that. I think they've done really well. I don't think they've been bad investments in the last 1 year, 1.5 years.
Haven't been bad investments, at least in the last 1 to 1.5 years. But